Welcome, fellow investors, traders, and speculators. In this video, Nick and I will tell you exactly what, when, and how things are going to happen in 2025. So stay tuned. And as it is the last video of the year, the next minute is a little bit of fun. If you don't like fun, go directly to minute 2 in the video. Bye-bye.
Guess who's back? Back again. Shady's back. Tell a friend.
I said this looks like a job for me, so everybody just follow me, cause we need a little controversy, cause it feels so empty without me.
So, what's everybody thankful for?
Yeah, la, 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 la.
No, I'm just joking. Let's have a nice dinner.
Can you pass the map?
Welcome, lady and gentlemen. Nick, what is it? It's the lady. Welcome, ladies and gentlemen, to the last grey market talk of the year. It's around Christmas time. That's when I get my Christmas jumper out. I'm here with my very good friend and advisor, Nicholas Themistocles, the man who used to manage more money than Scrooge McDuck. So much money, Nick. I'm always jealous when I see. And who's still in the business of managing money, mostly his own now, I think. But hey, whenever I need an update on markets, somebody to put me in the straight and narrow, because I'm more the tactical trading kind of guy, I ask Nick. So Nick, thank you very much for spending this, last show of the year here with me.
Looking forward to it.
Yes, and appropriately, I put my favorite Christmas jumper, Mr. America, or Captain America on. Quite fitting, yeah? With President Trump winning the election, and now everything will be awesome. Or will it? Yesterday evening, we had the Fed cutting rates as expected, and then the market took a big dump on that. Nick, what do you make out of that?
You know, I know that it's going to sound really odd, but I know that everybody really focuses on non-farm payrolls, FOMCs, and all of that stuff, and I really don't. And I know that there are charts which say he spoke here and then the market fell. I don't really link stuff like that so much. But anyway, what did he do? He cut interest rates as expected. What did he forecast? He forecasted 2 rate cuts next year instead of 3. And apparently, when you listen to some of the commentaries, that was a super hawkish FOMC because it's 2 rate cuts and only 3, and not 3 as it was before. Bad news for the market. That's such a load of nonsense. I mean, this market had forecasted 10 rate cuts, then 0, then 5, then 6. It's all over the place. Has absolutely nothing to do with rate cuts. It's nothing to do with hawkish or not. It's nothing to do with FOMC projections, because we know that the FOMC cannot predict anything, right? So who can? And we know that their forecasting has certainly not been very good. So what do I make out of it? It is absolutely nothing to do with the Fed. You've got to look at market psychology, and that's why the market came down. And it's nothing to do with the Fed, in my view.
So big nothing burger, yeah. But whenever I see on a daily basis a 3 standard deviation move in the S&P, and I see VIX volatility going up by 30%, I think maybe there's something I want to have a look into it. Coming back to the Fed, dual mandate, yeah, inflation and employment. Why is everybody panicking? The employment figures are highly questionable and they don't look good. And inflation is not really coming up, not really going down. You and I both know the times when we had inflation at these levels and interest rates higher, and everybody thought that was a normal market. Yeah?
We also had interest rates lower at these inflation levels, and it was a normal market. So in my view, this is really, don't look over here, look somewhere else for what's going on. And perhaps there's been an awful lot of speculation post-election Trump, post-Captain coming in saying it's a wonderful world next year and it'll all be fixed. And isn't that brilliant? So let's load up the boat. And there's been an absolutely shed load of money flying into dollar equities or US equities from overseas as well. I mean, look at the dollar. And, these are questions that you should be asking. What's going on with the dollar? What's going on with sentiment? Is everyone a bit too hot right now? And is it time to just sort of back off a little bit? And I'd say it's just probably a bit too much exuberance.
Oh, I found this beautiful chart. There's a website. I might put that even in the notes. Obviously, that must exist quite a while, but it was new to me. It's called the Euphoria Meter. Have you heard about that?
No.
It's absolutely awesome. It takes forwards PEs in, it takes a bullish sentiment in, and it looks at the VIX. And if you look at this Euphoria Meter, I put the chart in right here in our conversation. It tells us, oh dear God, we are very, very euphoric at the moment. And this chart, I stumbled across it last week or something, and that was fitting with my assessment of the market in general. But yes, we have euphoria in the market, and Bank of America came out with a monthly fund manager survey, and that was also very interesting. So there is negative, neutral, positive, and there is positive on fucking steroids, eating candy. And that's where we are at the moment. You are in that industry, Nic. What's everybody thinking?
Okay, so I mean, I have a lot of people who invest with us, and they want to put some money to work, and they came to me in the last couple of weeks and said, is it the right time? Trump and all of this stuff, and look at it, the market's gone up, and I put up a chart of the stock market, and I said, okay, circle for me on this chart the times where you really want to invest new money. And it's not sort of at the point where you're in one of these things. You might be fine for a couple of weeks. You might be fine for a couple of months. But are you going to be the person who's actually going to sell at the top and then get out again? My view is this is not a great market environment and not a great position in the market environment to actually invest. If you believe in the 7,500, then you have to believe in certain things being in play, and that is earnings continuing to grow as expected, multiples continuing to grow or stabilize where they are, and margins continuing to grow as expected. So if you believe that all of those things are in place, then in 6 months' time or 9 months' time, the market's going to be much higher than where it is today. I mean, I don't doubt that. But until that time, I would rather find the point in the market where you've got negative sentiment, where people are, suddenly saying, oh, it's a different environment, Trump's going to blow it all up. And find a good level to invest rather than just chase it right now. And I think this isn't really a time to chase. You want to look for dips. Yesterday was a dip. Maybe it's a good time to, maybe that's the only dip you'll get. Who knows? But
well, all the technical traders out there, they love to buy the 20 when the market dips at the 21-day moving average. And then they love to buy when the market dips through the 50-day moving average. We took both levels yesterday.
Yeah, I think we're at roughly just below the 50, aren't we?
Yeah. So
it's a tester for the market. So for all of those people who ran in, what do they want to do? Look at the dollar right now, 108. Is that really an environment where you really you think it's going to be all fine, all dandy? I don't think so. I think there's a big question mark about, if the dollar stays at this level, is this really going to be a good market backdrop, good macro backdrop to come in? And you really have to look a little bit closer to what Trump and Team Trump are going to be doing. If you'd have looked at the policies of Biden before he came in, and look at the policies of Trump before he comes in, you'd have said, oh, Trump's definitely got the better policies. But what actually happened to the market after Biden got in with all of his, nonsensical policies, war and printing money and, giving it away and this, that, and the other. And what happened under the Biden presidency, you had an amazing rally in stocks. So you had probably the worst environment, or the worst on paper policies, coming up with an extremely strong stock market. But what is Trump doing now? And Trump is unwinding some of those policies. So unwinding the policy of immigration, Keir Starmer made a speech 3 weeks ago, which caught my eye. He basically said, it was policy of the UK, and I thought he said of other governments, to increase immigration. What was the rationale for that? To spur growth. I mean, you have debt out, growing like crazy. So immigration, obviously, you increase the labor force and all of that stuff. You increase growth. So it was the policy of US, probably. It's policy of UK, according to Keir Starmer. It's policy of some of the European countries. Trump is going to unwind all of that. Now, if that was good for growth in the Western world, put it this way, well, it's not necessarily going to help growth if you cap the level of immigration or reduce the level of immigration. So there are things that you have to consider whether or not Team Trump is actually going to result in a stronger market or a weaker market. What else did Biden do?
Let me ask you a point on that immigration, because we all know, yes, if you add more people to a country, your GDP goes up. But is that actually real growth we have there, or is that just a headline number? Because the statistics that came out in the Netherlands, university statistics a year ago or something like that, actually showed the net contribution of that big inflow. That was always negative to the growth factor. However, it adds to the headline number. Yeah, GDP, fantastic. You add on more people, GDP goes up. Is that actually the growth you kind of want to see? Because now I bring in my killer argument. When Milei became president in Argentina, like today, everybody says, oh, he's going to kill the country off. Yeah, there will be poor people. I love this a fuerte, killing off the departments. Bloody hell. He reduced inflation, monthly inflation, by the factor of 10. They don't take any money in, and let's put all that aside. Have you seen the Argentinian stock market? There's one ETF out there. From the moment he took over, it just went ballistic. Yeah.
Yes.
Unbelievable. So taking all this into consideration, I'm with you. Yes, Biden did the one most important point, liquidity. He printed money and put it into the system. And that's why we've seen the stock market. And if Trump's policies with Doge and everything comes in, that's the question. Is he taking liquidity out of the market, or could he start with something like a big infrastructure thing? Yeah, where you say, yeah, they spent money the wrong way. They just gave it to people to buy hamburgers and PlayStations. So we are now putting it into the infrastructure. At the same time, we get Elon in, closing down the Department for Education and other things which costs lots of money. That is the only thing which would make me, in this whole scenario, positive on the future development of the United States.
Well, let's take that immigration thing a little bit sort of deeper. I did a presentation recently I incorporated some of these arguments, and I got data on real earnings for the people. 2022, 2023, negative. So real earnings are down. What does that mean? It means that the workers are not sort of participating in the growth of the economy.
Yeah.
The workers haven't been participating in productivity growth. So who has been participating in this thing? Corporates. So again, what's happened to corporate margins over the last few years? They've grown. So where has this come from? On the one side, they're selling their goods at a higher price to consumer. Price gouging, you could say, or just sort of improving the quality of the product. But on the other side, they're not paying the workers for the improvements in productivity. So that's not been very popular with that's why these governments are all falling left and right, because the beneficiaries of all of the policies of the West, conservatives been kicked out, everyone's been kicked out. Yeah. Oops. France has been kicked out there. My lights just fell off. Germany and so on. And so nobody really wants this stuff. So if you then say, well, okay, going forward, what is Trump going to do? So these margins now potentially aren't going to grow as strong. Why? Because perhaps the workers are going to get more out of the policies. And you can then say, well, if the workers are going to get more because they're the people who voted in Trump, they don't want to get less. I mean, that's for sure. They want to participate in all of this thing. So then is that enough to carry the stock market to the 7,500 and so on and so forth with the assumptions that we have today? And that's a big question mark. And then the next thing, you talk about printing money. So what was the other element that drove growth over the last couple of years is the fact that the government have just been increasing government debt. Some of it's inflationary, some of it's sort of been financed by the banks and increase in money supply. And it's gone into the street. It's money to be spent. So you say, well, Doge comes along and says, well, government spending should come down, rightly. So deficits too high should come down, rightly. Well, the moment you do that, then again, you take away from the growth in the future that you've enjoyed in the past. So as long as you're honest with people like Milei in Argentina and says, listen, I'm going to change some things. So we're going to have some difficult times. As long as you're honest and transparent with people about that, I think, Trump can get away with it. But I think there will be not such a smooth run into the euphoria that we saw after the Trump election. We still have to truly understand and appreciate what impact his policies are going to have, how quickly he can implement, and what damage he's going to create along the way, because it's not so easy. And then, I haven't even begun to talk about tariffs or what that does to world trade. Hopefully, the good thing is we don't have war risks on the horizon, but you've still got this economic shakeup. Now, the economy needs the moment you shake things up, then there's a risk you can actually sort of create some damage along the way. And I think that it's, the market priced post-Trump election victory as perfection. He's only going to do good stuff. There's going to be no negative impact from what he's doing. Let's just go and load up the boat. And I think that's everyone who invested between November, whatever it was, and today, is a very hopeful, no damage kind of view.
So we're talking about margins and bottom line that comes in, yeah? If Trump would actually achieve that by being able to, or enable the American economy to produce more stuff and have less inflation, the workers with tax cuts then would have more money. This more money could go again into the system and increase the bottom line of the companies while having lower margins in there. That's the best case scenario. However, that gives me the connotation of we would first have to see a dip before it gets then really, really good.
And that's exactly where kind of my thought process is. In order to fix something, you need to sort of shake it up. And when you shake it up, you have a potential or risk at least to change the assessment of the outlook. And when suddenly the analysts who've all gone one way, have to now sort of be realistic about what he's going to do and when he's going to do it. And then, then we have to sort of wait for the time where analysts say, okay, so the margin's not going to be 14% next year, it's going to be 13.5%. And we start to see these reductions. Well, those things take time to adjust, and therefore it takes time to adjust asset allocations. But I think those things are going to happen. I think, first, there has to be a proper assessment, a realistic assessment of what's going to go on. And then to say, as you rightly say, well, that probably means a bit of a dip. Don't know where to. It's not bear market. If we go down on the S&P from 5,000, what I said before at our last video, risk down to 5,200, I think is quite reasonable. It's a 10 to 12 or 15% dip. And then the market actually says, right, so now he's got his policy. Now we know what the impact is. Now we're going to take the positives out of it, and that's something to build on. And I think that's the kind of outlook that I've got right now. I don't feel like chasing it. This is not a chaser's market. I've let go of a number of investments at these levels. Certainly not been buying. I've certainly been recommending to people just don't get so caught up with this chasing, because like things like yesterday may well happen to you. You buy it one day, you look at your account, and suddenly you're 5% down, and that's your yearly return in one day. I mean, hello, it's not very clever. So I'd rather buy it at more decent level than where we have been, at least.
Now, you and I have been around for a couple of rodeos, yeah? And in the olden days, what you just described, or what I initially started with, used to be the proper way to analyze stuff, to say, okay, fine, this could happen, and then we will see on a timeline a dip, and then it will up again. Over the last couple of years, Nick, with the younger guys in the market, I have the impression we now simply start skipping steps by saying, oh yeah, well, if that's going to happen anyway, let's skip the dip and buy straight away till we are at what then, and I can't identify them now, neither can you, what then will be really unsustainable levels. But I'm learning every day new stuff, and this is the thing that crept in. I always say to my students, long-term trends in the past were months, yeah? Now it seems like from market opening till closing in the evening. That could have been a long-term trend, and then everything changes again. So fundamentals will play a role at the end. I'm absolutely with you. I took the parallels with Ronald Reagan. Ronald Reagan, when he took over, the stock market actually didn't too well after that, but he built the economic base for Clinton to reap in all the rewards that came in time. What he did, he reduced taxes massively, very positive, yeah, makes economies grow, but he didn't reduce the deficit. The hawks still were able to say, yeah, fine, let's spend and spend and spend and spend. Could we end up in a situation like this again?
Trump is not going to reduce the deficit, so that's for sure. If he does, then I think you really have a recession in the States. What he's going to do is so he's not going to reduce the outstanding debt. That will continue to grow. But the yearly deficit, which has been running at something like 7%, is going to be a little bit less next year. So according to Scott Bessent, the new Treasury Secretary, the guy who's taken over from Janet Yellen, we've discussed, the two candidates. So Scott Bessent is going to be taking over. And his view is that the deficit should be around 3% a year. So in other words, the US debt pile will grow over time, but less fast than it has been growing under the Biden administration. Well, how do you go from 7 to 3? You've got to cut 4. Well, where do you cut 50% of this 2 trillion plus deficit? You do not cut this deficit by allowing the Federal Reserve to do what they want. So the first cut you're going to make is you're going to say, sorry, this interest rate number is a little bit too high. The average interest rate on US debt is around 3.4, 3.5, something like this. So any interest rate that is going to be, any refinancing that happens above the 3.4, 3.5% is going to increase the interest rate burden of the US. That has to come down. Mr. Powell, that's unacceptable. Oh, you don't agree? So step in new candidate for Federal Reserve. This has to, I think Trump will take control of the economy, and that also means taking control of the Federal Reserve. And as I say, a big chunk of that, of what they're paying every year, this deficit, 1 trillion plus per year. They just announced the budget for defense. That was less than 1 trillion, right? And they're paying 1 trillion. Who is this money going to? It's going to the wealthy, it's going to billionaires, it's going to, people who have got money. Who were the people who voted for Trump? None of those fellas. So there's absolutely no way that he's going to allow this money, which is effectively coming out of the government and being passed to, the rich folk. There's no way he's going to allow that. And there's no way he's going to say to Trump, to Powell, yeah, you can do it. 5%, yeah. Well, Powell said yesterday, don't rule out rates going up next year. Good luck.
Yeah, well, it's not going to happen.
I think that was a resignation statement if he really meant that. But
at the end of the day, Trump is a builder, yeah, and builders like low interest rates. It allows them to have a land bank. It allows them to invest. It allows them to do all sorts of shenanigans at zero costs if you have really low interest rates. So yeah, let's take that into consideration. And I'm with you on that point. I've heard a podcast from Stephanie Pompoy the other day, and she said the Treasury has to roll over 10 trillion in short-term debt next year. Well,
and what Janet Yellen tried to do in order to yield curve control, she already did yield curve control. So she capped the 10-year yield, which sort of reduced the volatility, which sort of helped collateral. If you sort of remember from the liquidity environment, collateral actually sort of is something as part of the liquidity calculation. So she says, I've got a good idea. Let's just issue T-bills. I've got 2.5 trillion in a reverse repo account. Let's just roll that down. This thing will go. Banks will lap it up. I mean, that will increase the money supply. It did. And Bessent said in one of his interviews that I saw, he said, we need to term out the debt. And terming out the debt effectively means, I think we've got too many T-bills being issued, and that's what emerging markets do. They get financed by the bank. It's what Argentina did, God's sakes. So I think we need to gradually, and he used the word gradually for a reason, because if he says, well, I'm just going to shift it all to 10s and 30s, this market would have gone more haywire than it already has. So the term premium for 10 years will gradually increase, normalize. The normal spread between sort of Fed rates and 10 years about 150 basis points. We're nowhere near that. So there is room for the 10-year yield to go much higher, and especially at the time when your Treasury Secretary has effectively said, we're going to issue more stuff at the long end, unless he does something like issuing paper against gold, against Bitcoin, against hard assets. He's going to have to pay more money in more interest rate to actually do that at the end of the day. But he certainly doesn't want to overpay in the short end and just sort of, line the pockets of the rich folk.
It's very interesting. Do you know who did that in the past to stabilize, at this time, hyperinflation, issuing stuff against real assets? Hilmar Schacht, Weimar Republic, who then also was head of the central bank under the Nazis. But before that time, we had hyperinflation in Germany, and there was no way of solving this problem besides offering people something against the currency, the paper money they were issuing, and actually put a huge land bank in, forests, all that kind of stuff. That's a very interesting idea. I've never thought about that. That would be would explain why they want to buy 1 million of Bitcoins, right?
Yeah, I actually brought it up in our last interview. I mentioned just do a 100-year gold issue, right? I mean, why not? And what is all of this stuff you got in Fort Knox for? Which you anyway don't check, right? The last time I saw it was in a James Bond movie.
Yes.
Right. So this is make use of your reserves and Chinese. What are they doing with gold? They're buying gold, and it's not just the retail who are buying gold. It's the central bank who are buying gold. They want to give credibility to their currency, and that means they need to strengthen the reserves, not just holding treasuries, but other stuff.
Oh, I put an interesting slide in right here now. It actually shows Goldman Sachs came out and said there's the official numbers of what the Bank of China is buying in gold, and then that's what Goldman thinks they are doing. Obviously, you already gave it away. They're buying far more gold than what is officially known in the market. Apparently, they're riding through the London market, skipping up everything that is out there. So interesting. Now we had a correction in gold yesterday evening, quite a substantial one. Could be a little bit more downside there. I'm a gold bug anyway. Yeah, my gold performance this year was off the chart. So cool. Yeah? Even if I'm not invested in the S&P, I was in gold. So what's your view on that? Should we stay in gold, Nic?
So at the last talk that we had, I said I still felt that
there was time for a correction.
Would go down to 2,300 or 2,400. In the meantime, I sold some stuff, yeah. But I must say I'm nervous, right? I mean, not having enough gold is problematic, I think, in the world going forward. And the problem is exactly that, the necessity and the understanding that all of these countries will continue to debase their currency, and you need stuff that is not going to be debased. And, whether that is a crypto or whether that is a gold or a silver or land or a nice car or a decent watch, whatever it is, right? You need stuff that is going to protect you. And so, why do we think that stocks have been going, gangbusters, as it were? And it's not just about all of the maths and, let's hang on a minute, PE times, multiples, and that equals S&P 7,500, because you can just sort of increase the multiple on this stuff. And why is that? And that is a statement from investors to say, how do I value cash and how do I value stuff? And stuff is worth a lot more than cash. And so, if I have to pay PE multiple of or whatever, then I'll do that because I just don't like this cash, because I know that what's happening in the world today is debasement, a topic that we've been talking about for the last year and a half, 2 years, and why gold is important in your portfolio. That's the reality. It's the cash part that's worthless, and you need to think about what else you're going to do. And the problem is now is, if you haven't invested or you're just about to start or you need to add some investments to the market, you're ending up paying multiples that frankly you don't really feel comfortable. You don't want to pay 100 grand for Bitcoin. You don't want to pay 6,000 for the S&P. You don't want to buy the dollar at 108. All of this stuff. And so this is a very, very difficult time for new money. And you really have to shut your eyes, because otherwise you're going to get days like yesterday. And therefore, what does that mean for your strategy? So previously I said, strategic was more important than tactical. Tactical is more important now, because we've reached those heights, those dizzy heights where you say, right, well, I've got to be nimble, because over a 10-year horizon, the likelihood of me making my 7% per annum is probably a bit sort of low. So let's just say I don't earn 7%, I earn 5 or 3 over 10 years. But in the meantime, the market's doing all of this. And obviously you're an expert in a product that helps you maneuver your way through choppy markets, I would say. And that's something that more and more people are going to have to think about, that tactical element in their portfolio, in order at times like this. At times like this, you can't just say, well, okay, Bitcoin's 100, it's going to 150, it's going for 500. I just shut my eyes. S&P, I just shut my eyes. Sure, you have a boring portfolio that does that, but the real money over a long period of time, you need to sort of take advantage of these swings. And so it's not all of your portfolio, it's some of your portfolio.
Yeah, well, it fits in nicely with my fringe theory that actually equity markets haven't done anything for the last 20 years. What we have seen is a crash in fiat currencies.
Yeah, I mean, you could say that. That's certainly, if you ask people who are struggling to make ends meet, that's they can't buy a house. They can't buy a big car. They have to buy a small car, a second-hand car, or whatever it is, and that's the world we're in today, and we're in that sort of space.
Well,
we went through a printing exercise after COVID.
Nick, we're old enough. Yeah, I remember the first time, still in Deutschmark. Yeah, I made more than 100,000 Deutschmarks a year. I was fucking loaded and rich.
Yeah.
In euros, that's 50 now.
Yeah.
With 50 euros, nobody in their wildest dreams would consider themselves loaded. Family, no family. Yeah, that is actually what you can see. The fiat currencies have crashed. If you were loaded up in assets, good companies, you could have bought an Amazon at 27 cents in 2002.
Yeah, indeed. And as I say, there are times where you want to kind of invest your money, and there are times when you have to say, be cautious. And I see this as one of the cautious moments in, and therefore you've got to be a little bit tactical with part of your portfolio. So, I recommend 70% boring, to set it and forget it. But you really do need that, a percentage of your portfolio, which is going to be more active, to protect you in times like yesterday, or, if it lasts a little bit longer than that. You need to be definitely active. You need to think about this type of trading, if you like.
Welcome to the tactical brief, because I thought about that as well. Portfolio structuring. In the olden days, you started buying good stocks, good companies, you had an idea, and then eventually you started hedging your portfolio. What you just described, that we are in a scenario, gold is expensive, Bitcoin is expensive, equity markets are expensive. What does fresh money do? And I thought long and hard about it and thought maybe you should totally turn the portfolio structuring process around. We start with a hedging first. And then we start adding on assets into the process when we are at these levels. We've done that now for a while. Every time volatility, VIX was trading below 15, we started loading up. Yeah? Yes, we were paying the carry for it, but I'm happy to pay the carry for this stuff, which was happening like yesterday evening. We simply think, okay, the equity market has enormous high valuations. Do I really want to invest in here? No, I want a correction. What am I doing? I want to have my cash in cash, still gives me 4% or whatever. At the same time, I'm risking a carry premium to get insurance for something which I don't own yet. To say, fine. In the meantime, I sit on the sidelines. However, when I mix it in an appropriate way, like yesterday, the stock market makes minus 3%, VIX makes plus 30%, right? Get the mixture right, and you have a business case there to say, okay, cool. Now I can start putting stuff in if I really want to buy Elon's company or not. But the whole structuring process should be actually flipped on the head. Start hedging first if you have fresh money on the line. Don't invest it in the market, and don't go in and invest in the market and then start hedging. I think that is more appropriate actually to protect your buying power. And it also fits nicely in line with what Mr. Buffett is doing, right? He's selling hand over fist. And I've seen these beautiful charts. And one of my students asked me, why is he always selling at the high? And I said, well, he's not selling at the high. He's selling all the time when we're approaching a high. But when the market dips, then he has the maximum exposure of having sold. So it always looks awesome in history books when we have it there. But he's got the right strategy. Getting cash, waiting for an opportunity to buy in as long as you believe in the system. And that's what we both did. Captain America, Trump is here now. If he does a melee and doesn't falter, he can bring in long-term growth, how the Americans have seen it under Reagan, or in Germany, how we have seen it under Social Democrat, Mr. Schröder, who came with his agenda for people who don't know it. He was actually called a socialist. He mixed up Germany, he reduced payments, he produced the right incentives, he reduced taxes. A socialist who did that, not the conservatives who came in before or were in before him or came in after. And then the long-term conservative government was benefiting for over a decade from the things he put in motion. So that would be my scenario for the United States. But at the moment, I'm with you. Could the market wait? The old adage to say, buy the rumor, sell the fact. We've bought now the Trump rumor, and let's see what he actually gets through when he starts in January. Is he serious about it? Will he be able to do stuff, or will it be like his first attempt on the presidency, where they didn't let him do what he wanted to do, and he believed in kumbaya, which didn't happen, obviously.
I have every faith in in him delivering on what he said he's going to deliver. I have every faith that Musk and Ramaswamy are going to take the equivalent of the Malay, or did he have a chainsaw, at the costs. There might be some frustration though, because in order to really take the chainsaw on some of these costs, you have to be ready to communicate the consequences to the people, because it will not be without sort of some side effects, if you like, on the economy. The economy may well stumble. He may well say, look, we need to cut. And then somebody might say, look, if you do that, the economy is going to sort of struggle a little bit here. Do you really, we're not sure we want to support that. And I think he could be quite frustrated about it. But
aren't we, sorry to interrupt you there, but aren't we already primed in believing that? Because if you cut government, what do you cut? Productive assets or even counterproductive assets. So yes, there will be a lot of people in the administration losing jobs, and you will have to pay their benefits until they get a productive job somewhere. Last week there was in the news some guy who worked for some agency, I don't know, who posted on TikTok how he was working in his bathtub with his computer. Work from home. Don't tell me these guys have any benefit for the economy over there. So if you fire them, yes, you will have to pay until they get into productive jobs. But that could be only a short-term thing. And I think that was as Millet is playing there. So coming back to this point, if you have the trust in Trump will do the right thing, shouldn't I load up like crazy here long-term?
Long-term, that's exactly the point. Long-term is great. In 5 years' time, he may well load up. that might well be the right thing. But what's going to happen in the meantime? And as I say, I don't think it is a straight line to Trump's eventual success. I think this is going to be fraught with economic, stress wherever that's going to be, and for that reason, I think this is not going to be one of those easy situations where you can set it and forget it. And the idea that you suggest of buying some insurance in an environment, when people get complacent, you're below 15 VIX, go and load up some long dated volatility protection, or however you want to structure this thing, might make a load of sense. But the majority of the people who are putting money in don't do that because they don't understand it. Complex stuff. How do I do that? Is there a product out there that I can understand that can help me in all of this? And I think for those people who are saving for retirement, that's going to be that's a big question mark, I must say, and not so straightforward.
There's one other big point in the survey of Bank of America fund managers. The big catalyst, positive catalyst for 25. Guess what was number one? Chinese development. China, China, China. And obviously now we're jumping quite a couple of miles to the right, depending on where you stand. Do you see a chance in China actually going back to a progressive growth model, which will enable or fuel the whole world economy?
I don't think they have a choice, right? So the Chinese have always wanted to be dictating their future and not have it dictated to them by anybody. But in an environment where potentially their biggest growth driver is their exports. So their exports are amazing. I mean, they are, they're selling cars to the Germans, right? That's how good they are, right? And there's going to be somebody who's going to say, well, we don't like that necessarily, or at least if you're going to do that, we want to take some of that benefit away from you. And the question is whether or not the Chinese can afford to let go of some of that benefit, whether they devalue, whether they don't devalue, because if they do, they'll be the people who end up paying when they start to buy stuff overseas or invest stuff overseas. So it's a big question mark. Can they afford it? And if they can't, what they need to do is to develop their own domestic demand, or develop the Asian domestic demand, and less focus on the Western world and more focus on the BRICS, if you like, and the people in that region. We just don't know how they're going to do it. We have no idea. But I don't think they can afford to kind of just fill up a hole with the money that they're chucking in right now is clearly not enough. And they do need to grow their economy. I think it's an imperative. The question is how quickly all of this can happen, and does it happen without any sort of financial stress? Who's going to buy the bonds? And so on and so forth. All these questions, you just can't fix problems without breaking something along the way. And I think they've been very cautious to avoid breaking things. But I think there's going to be perhaps an urgency where they might have to act faster than they really want to, but they need to do something.
We've seen that in the past, right? China was, when they realized that they were in economic trouble, they changed their model again. And President Xi was more on, how do you call it, a hardliner, more state interference. If there's a chance that he rolls that back, China could become into the position again where they are the motor of the world. Brings us to the other engine, which is completely crapped, Europe and the UK. We are playing a substantial role in there. If Europe really is being flushed down the tubes, you don't have a world economy growing. It's simply not happening. If one of the biggest blocks, 750 million people in Europe, are in not just a recession, but a depression, where's growth coming from, Nic?
That's a real good question. I was out the other day. Frankfurt is buzzing. I just don't know where the money's coming from, because they obviously don't work in the car industry, the people who hang out here. But seriously, it's a big question mark. It's a question mark for Europe. They need to find themselves. The political landscape first needs to get shaken up. The corporate world has decided that Europe is not the place to grow your factory. So there's a lot of interest in growing your factory in China, in America, and not in Europe. There's a lot of things that need to happen, and they will take, an agenda 2020, I was going to say 2025. It's got to be agenda 2035 for somebody bold enough. And they need to fix it because it doesn't look very clever at the moment, I must say.
Well, we have elections in Germany in February, and that's going to be interesting because the majority of the people want to have a conservative government, but that is not going to happen. So all the lefties will cling together, and we'll have more of the same here.
Yes, I think so. I think you have more of the same, and I can just point to everybody wanted the Labour government to go into the UK, and the Labour government come in. Now they want to get rid of the Labour government because they don't have the answers at the end of the day, or at least they don't have the answers that the people want to hear. And they're focusing on things outside of the UK and not in the UK. That's always one problem. They still don't know, what economic policies they need to drive without destroying the economy. And at the end of the day, it's just, they are so reliant on what's going on in America and what's going on in China. There is no sort of economy within itself. We are part of a global world right now, and we are so tied into this global world that actually trying to find ourselves in this space is going to take years.
Well, thank God the French have their house in order and can save the whole thing, right?
Well, yes, indeed.
You see where I'm going with this?
Absolutely.
Because,
Sorry,
if they are blowing up, yeah, and they're about to blow up, they have, but we discussed that statistics, I think, in a previous show, that France have more debt than the whole continent of Africa. Yeah, so, and they've just disposed of a slightly conservative government because they didn't want to spend more money. So they are broke. Germany's broke. Italy, well, I don't know what they're doing. Let's keep them out here. England, the Great Britain and the United Kingdom is on the wrong footing. So we have the United States, which has a real fighting chance to twist it around. China is at a decision point where they have to say, okay, what we're going to do, in which situation we're in. But Europe is dragging this whole thing down massively. Now you have the explanation why the dollar is so strong. They have to print money in Germany more than in the United States, and that will be by a magnitude of what they print in dollar will be printed in euros, because that's the only way how they at least can put bread at subsidized levels in the shops eventually in Europe.
Yeah, I mean, I just there are two aspects here. If Europe struggles, then remember the American companies don't just sell to America; they also sell to Europe. And one thing I always learned was when somebody says something is dead and it's uninvestable, that's usually a good time to invest in this stuff. So now, whilst I wouldn't necessarily say buy Europe and sell US right now, there's a big question mark as to whether the gap, this exceptionalism is going to continue, at least in the short term. Yeah. In the long term, you'd say that the Americans are trying to fix it and Europe is still a long way away from fixing their model. But the Americans are also going to be a long way fixing it. And as I said before, I think the damage that will be done along the way until you fix something means that probably they feel the pain first. And therefore that's a difficult investment environment.
So in global terms, 70% of all the investment money is in the United States, yeah, of the global funds.
Probably more, I would say. Yeah, I mean that's the MSCI world is probably north of 70 right now, and it's certainly where all the flows are. I mean, money is going there because it is the only place to invest.
That would have been my question to you. You do a global asset allocation. Yeah? What are you going to do? Do you stay in the United States, or is it already? Do we already have blood on the streets in Europe, in France, in Germany, in the United Kingdom that you could say, "Oh, fine, I'm switching a little bit over," or is it too early? I was still bleeding out.
So the question is, with all of the flood of money that's coming into America, I mean, let's look at how you get the bubbles in the first place. How did Japan blow up? The money sort of goes into, this is the only place to invest,
Yeah.
in the 80s. So everything is Japan. They're taking over the world. And then sooner or later, it doesn't become the right place to be. So nothing lasts forever. And therefore, there comes a point in time where reality has to set in. But I agree with you that when you look at it on paper, you'd say, America, all of it, and nothing to anyone else. But what are the consequences? High dollar. So what do you do with your dollar? Do you hedge it? Do you not hedge it? Can we sustain a global economy without interruption or without sort of any problems with a strong dollar? I mean, we're at 108 today. Let's just say we get to 110, 115. What's going to happen to the economy? It's not one way. So, and then you've got Jay Powell, who, says, well, I might raise rates next year. Hello. Sorry, just wake up. What's going on in the world?
Well, I would have loved to see Jeffrey Gundlach's face when he heard that line.
Yeah, I mean, he of all people, especially. So, you need people who understand and can take a more serious look, at your models, at the economy, the global economy, and all of this stuff, and not just sort of blindly, well, this is all I understand, and 200 PhDs or 400 PhDs tell me I'm right. And if they tell me I'm wrong, by the way, they're out. And it's just not on. So we have to also think about how these central banks are being run at the end of the day, because are they steering the economy, or is that done at the government office? So is the government steering the economy, or is the Federal Reserve steering the economy? Is the Federal Reserve behind the curve, or is it in front of the curve? Does it influence the economy at all? I don't think it does. Right? I just think it transfers money from government to rich people. I don't think it does anything else than that. That's its job, right? That's the reality. It's had absolutely no role than anything than facilitating that for the government. So the government in the end run things. So the government, so we have a new government. So tell me that changing policies which went from this direction to this direction, because it really is 180 degrees, is going to be smooth. I don't see that.
Well, that's how you started this conversation, with your very robust thesis that the Fed is actually not knowing what they're doing. Their forecasting ability is zero or even slightly negative. You could take the other side of the trade with that. And governments make policy. So now we have a good government in the United States.
Yeah.
Allegedly. Yeah. Let's see what really happens.
Yeah.
Whether I would lend my Captain America jumper to President Trump or not. But we come up to my lovely old analogy. What's the cleanest shirt in the dirt hamper, right?
Yeah, I mean, as I say, there's a time to have cash and there's a time not to have cash. And we know that up until now, people have despised cash. That is why stocks are here, Bitcoin is here, gold is here, because, cash was a dirty word when you are printing cash like crazy out there. And every government has been doing it because they want to get voted in again. So they can't dish out enough money to their friends or to the voters or to the people coming across the border, because they can get in again. And what you saw was that actually the things that you would look back and you'd say, growth, yeah, tick. Sort of stock markets stonking, tick. It's got to be a great job. No, none of these people have been re-elected. None of them, because what really matters is the money in their own pocket and how they feel. And I think this 180 degree is necessary. And I think Trump sees it. That's why he is there. And I think repeating what actually got you to an all-time high stock market, repeating, the other decisions that they've taken place. Fed don't care. Where you began this conversation, what do I make of it? I think, don't care. This is like a non-farm payroll number readjusted. Don't care. It's a meaningless distraction to what's really going on in terms of capital flows, money, investment. It's nothing to do with the Fed. Don't focus on the Fed. Focus on other things. And as I say, right now, I think it's a very, very difficult environment for new money to come in, purely and simply because, I think the way I am, I just hate to chase, right? So I'd say I'd rather buy it. If I have to wait 3 months, I wait 3 months and say to somebody, buy it when it looks pretty shitty. Don't buy it when it looks like a no-brainer, because it's not a no-brainer. Be selective on your stocks. You can actually sort of make some good money. Again, it comes back down to tactical. What do you do in an environment where you can't place your sort of strategic long-term money? You've got to be a bit tactical. You've got to say, okay, let's look at some, the stocks I like, the stocks I don't like. Let's try and buy some of these. Let's try and sell some of these. Let's try and make some money until I'm ready to invest in the markets again. And that's how personally I'm behaving.
That's also my impression, yeah, that the time of the Delta One product, just buy an index and be happy, could be over. That is becoming more and more selective, because in all these conversations, what always gives me confidence, going back to, do companies actually make money and how are their margins? And you will have to do an individual analysis for that to say, is that actually still happening or is it not happening? Then you take a longer time horizon. In the meantime, you don't get screwed over. But the dynamics we've seen, yeah, the market performs to the upside like crazy because everybody's going into Delta One, just an index. This can go both ways. Huh? I don't know whether we are at the beginning of the second wave to the downside, how fast that will take us. But maybe we can even close on that and say, yeah, individual stock picking might become fashionable again after it's been out of fashion for the last 20 years almost.
Yes, absolutely. And yeah, I must say that's exactly where I am right now, and looking at, really long short. I quite like that game right now, and it allows you to to benefit from.
Oh, Nick, is it already time for me to short the crap out of the market, or shall I still hold my powder?
Well, I am. I mean, as there have been certain points where I have actually sort of put on a strategic position, and I think you can do that fairly cheaply. With these sort of these call spreads and put spreads. Sorry,
Well, that's what I'm doing now. I'm talking about really shorting the market. Apply
okay.
leverage to it and say, yeah, let's ride the wave to the downside. That's where the fortunes are being made, right?
Look, I mean, when I first bought Bitcoin, it was money that I said, don't care. And shorten the market is money, it's like taking a Bitcoin trade and saying, okay, this money, if I lose it, I don't care. And I think if you're ready to do that, then you're ready to do it. At the moment, I'm a bit more cautious about it. And
I was about to say, you do care about Bitcoin now, do you?
Yes, I do. I still own it. I've reduced crypto. I've reduced gold. I've reduced stocks. And I think that's the kind of the right thing to do in a rally. If I'm wrong, then I've still got stuff to sell. And if I'm right, well, maybe I sort of come in again and we have another look. But you have to be more flexible, I think, in this world. And something which is core, where, let's just say you had your boring portfolio, allocated gold, Bitcoin, some stocks as well, you left in. This thing was 70%, let's just say, of your portfolio, or 80%. And now it's like 95%. What do you want to do? So bring it down.
I thought a lot about that recently. Tom Sosnoff, the founder of Tasty Trade and Think or Swim, he said that line years ago. He said, I don't really have an opinion about Bitcoin, whether it is something or it's not something. But if I see volatility that high, 1% of that stuff goes in my portfolio, because the downside is zero, the upside could be infinite. And that always stuck with me to say, if I see the next big thing, which nobody knows what it is, 1% should end up in your portfolio, because what's the downside? 1%. Yeah? What's the upside? Massive improvement over your overall performance of the portfolio.
Yeah, I mean, what we didn't talk about, and maybe a last liner, we went from AI, NVIDIA is the thing, to actually maybe it's not quite the thing, and maybe we need Broadcom, and maybe that's not the thing, and maybe we need quantum computing stocks. You know what I mean? This cannot go on. We're one day crypto, next day, NVIDIA, next day, Broadcom, different type of chip, fancy, not tech savvy, no idea what that's about. Quantum, it's moving this speculation to the MicroStrategy sort of debt, which has been bought by some of these pension funds, which I don't get. maybe I'm not smart enough to understand what they're doing. Why don't they just buy Bitcoin if I like it?
Let's put it that way. I heard an interview, a 1 hour podcast. One of my students sent to me. What's his name? Michael Sailing or
Michael Saylor, yeah.
yeah. And this, if I had Bitcoin holdings that wanted me to sell everything I hold immediately, because the sales pitch he gave there, and it was a sales pitch, nothing else, was like, what's worse than having, or what's better than holding crypto or Bitcoin? He said, more Bitcoin. And what's even better than that? He said, even more Bitcoin. It was
Yeah.
just this one-sided
Yeah.
banging
Yeah.
it in. And I thought, whatever might be the merits of Bitcoin or not, but if I hear a salesman out there being
Yes.
completely, magically inclined to, well, tell the world that what he's doing has the infinite money glitch in his machine and people are buying it and leaping it up, at the end of the day, it's good salespeople who are flocking this stuff, and it's too one-sided for me now. Anyway, I just wanted to slip that in because I like this line. So what's worse than, or what's better than owning Bitcoin? More Bitcoin. And what's even better? More Bitcoin of that, twice as much.
More Nvidia, more Broadcom, more quantum computing, more, more of it. All of these stuff have gone up, got more gold,
Have you heard about that? We spoke about that at the beginning of the year already, when the first rumors were showing up that the huge turnovers in these AI companies could actually coming out of that they are selling their product to the subsidies whom they are lending the money to buy the products. That it's getting more and more prominent in the news right now.
Is it really?
Yeah. I've heard it now a couple of times. I have to check, search what's it, Google Trends, if that pops up, because that again, being an older trader, reminds me of the 2000s.
The WorldCom,
Enron, WorldCom,
absolutely.
all the magic we had there.
The good old days where we thought the accountants have kind of learned their lesson. Maybe they haven't. I mean, but maybe that's just another one of these rumors. We don't know, and the world is a little bit more complex, and it's makes life a lot more difficult. I must say, for people who are trying to save for pensions, put money aside. When there's all of this stuff going on, it's just gets more and more. And I really wonder whether the fund managers are so up to speed with all of the technological changes that have taken place right now, because in a very short time window, we have had an incredible amount of stories of technology, and America is the only place for this technology. And I must say, it's just not silly, but I don't know about all of the other stuff. ChatGPT for a one-man band, effectively, or a two-man band, is really helpful, and so it's helped my productivity. It take hours to do some of the stuff that I do on presentations, and it's really good. So there is definitely benefit. Question is, who is going to benefit from this stuff economically? And the question is, small companies. And I still quite I saw a podcast with somebody who said small companies, forget them. I actually think that they're going to be the major beneficiaries of all of this thing, because they're the people who can't afford the consultants, the investment bankers, or these sort of people who come out of college. So again, for the future, I quite like the idea of AI benefiting smaller companies rather than larger companies.
Yeah, no, I'm with you on that. We've seen it before. Internet, big hype. Then first they had to monetize it. I think we're at that stage now. Big hype, justified hype. Yeah, it makes life easier, but now you have to find a way to monetize this whole thing. If a small company like yours or mine pay, I don't know, 80, 90 bucks a month, how many do you need to actually have this huge business model to chip it in when the competition is so large? Everybody wants to get into that space. So it will have a positive impact, if it doesn't kill us all, on humanity. Yeah.
Sure. That's down the road. It's one of these down the road things. We have to enjoy it on the way there. And we do, right? And it is a very, very helpful development, I must say, but it's the only thing that I have personally seen. We talk about crypto, and I am a big fan of crypto, but I'm still waiting for the use case and and other than sort of sticking it into a vault somewhere and saying that you own 5% of it and you're America and you've got some added to your reserves. there has to be something more to it than that. We have to sort of see this thing hit the real economy, tokenization, and all of this thing. We need to see that. At the moment, that's really so far down the road. At a good level, I will be selling my stuff because I just don't see it at the moment. I see it's too slow.
Nick, as it is Christmas time, what's the moral implication? I always thought about that. If AI becomes really intelligent and eventually becomes sentient, can we then make a sentient being to do shit for free for us? Or is that actually slavery?
That's one for a separate discussion, I must say. But
Yep.
I don't know.
Is
Don't know.
AI suddenly sending me a bill every month?
These are good questions. I feel that this could be a longer topic for next year.
Lovely. Nick, I thank you so much. So let me sum that up. We don't know what's going to happen. We know the Fed is not good in what they're doing, so we shouldn't put too fine a point on it. Politics is the game. We see here, United States has a chance. China has a chance to make it. Europe is a bit further down the line. They first have to run the ship really into the ground before they start changing things. And in the meantime, follow my, not new, or I don't know whether I came up with it, probably not. If you want to restructure your portfolio, and I think it's really expensive here, start with the insurance part first, and then add on eventually selective, after you've done your analysis, high quality stuff, which in the long run will perform. And there we leave it for this year. Thank you very much for being our guests. Thank you very much, Nick. It always puts my head straight talking to you. And we shall then, full of, well, new spirit and enthusiasm, start next year with a starting podcast without a nice jumper, obviously.
Indeed.
Bye-bye.
Bye-bye. Happy festive season.
From me as well. I say Merry Christmas because I'm an old-fashioned kind of guy. One last story, just it's a laughing bit. I used to work for Penmuir Gordon in London, an old English investment bank. My company, West LB, bought, and I was running the derivatives side there. And when I was there the first year, they sent out Christmas cards, which was a big thing at the time. Everybody liked to get Christmas cards. And they sent out Happy Holidays to everybody. And I thought, okay, fine, that's a new thing. We don't say Happy Christmas or Happy Hanukkah anymore, or Happy Diwali. It's now Happy Holidays. Then I started after a couple of years working for a Jewish bank, Bear Stearns. Christmas time, the first card I was on my desk, Merry Christmas to all our customers. And I thought, yeah, you got the spirit, guys. Merry Christmas to all of you.
See you. Bye-bye.